Let's say you close on a deal today. How long does it typically take you to lease that property out?
I think the average is 10 or 11 days, but it's fascinating because we've had some homes that have leased in 8 hours, and we've had some homes that have taken 3, 4 weeks.
When you are calculating that equity, are you having a third-party appraisal company come in quarterly and tell you how much your house is worth?
There's a company called House Canary. They are the valuation service online. We just pay $4 per quarter, and then they spit us out valuations. We use those to value the properties.
What would be the top tip or piece of advice that you have received from some of those advisors along your way that's really shaped how you've thought about building Scholastic?
My top tip for somebody who's thinking about investing in a real estate fund or syndication is...
All right, everyone. Today's guest is Sean O'Dowd. Sean is the founder of Scholastic Capital, where they buy single-family homes in elite high school districts and rent them to families on 3-year leases. Sean, welcome to the show.
Thanks for having me. I'm excited for this.
Of course. Well, this is a new podcast, but funny enough, Sean and I had actually recorded a podcast together maybe around 3 years ago now at this point. And when I was kind of preparing notes and things that I wanted to discuss on today's show, I've recalled that prior to ever raising a single dollar of outside capital to start Scholastic Capital and go after the thesis, you were actually buying these single family homes in good school districts by yourself back in 2020. So I want to start off today's show and talk about what that story was from going from buying private real estate investments yourself with your own capital to actually raising a fund and why you went down that route.
Yeah, for sure. It's funny because people ask me when Scholastic started, and you could say it was a couple months ago when we actually started deploying investor capital, or you could say it was a couple years ago when my wife and I started buying homes that fit this exact thesis, or you could say it was even longer ago when I was growing up, because that's when I first had the idea. So I moved 22 times before I went to college. My mom was a teacher, and the combination of all of those moves and the mom being a teacher, I kind of realized, hey, there's a pattern. Like, no matter where I live, there's always a really good school in the area that everybody knows about, and everybody knows, oh, it's that school, and every parent wants to get their kids to go into it. So for me, when I started my career, I was working in consulting. I was doing a lot of private equity work. It was focused on the idea of like competitive advantage, right to win, what makes one company better than another. For me, it was like, hey, I've always had this belief: a house that can send somebody to the best school is a huge inherent competitive advantage. So my wife and I have been doing it for years of just buying homes in good school districts, renting them out, and we just kept on doing them. They just kept on performing better than what we expected. And I knew I always wanted to get into doing real estate full time. But what was interesting was, as I was sharing a little bit more publicly on Twitter about what we were doing, I started getting messages from people like, hey, next time you buy one, like, I'd love to kick money in. Or like, this is actually really interesting. Can I see some offering materials? Like, I wasn't planning on doing that until I had a lot more gray hair than I have now. But it got to the point where what we were doing was working, and there was enough investor interest that it made sense to do it now versus waiting longer.
So knowing that you've always wanted to get in real estate, I know the path prior was working with Catalents, working with larger companies, being that individual consultant contributor, and Parking Profits, 1, 2 great deals a year. Like, speaking candidly, from what I do today, that's what I do. Right. And so selfishly, I would love to walk away from 40 minutes from now and think to myself, damn, I should be raising money because the grass can be greener. Like, what truly is the allure? Because it's not like you went from never doing real estate to doing real estate. Like, you were doing the thing. So, why raise capital? Why take on investor headaches versus just continuing the path?
It's a great question, and you're right. Like, there's a lot more headaches associated with it. We have SEC reporting requirements. We have a lot of accounting bills. We've got 2 different accounting firms. One does the books and one audits the other one. Like, there's a lot of added hassle that comes with adding on investors. The reason why it made sense for us, and I truly think it makes sense for us, it doesn't mean it's a blanket statement, it might not apply for you and your business, is with our thesis of really good homes, really good school districts, there's only 21 school districts in the Midwest that fit what we're looking for. And if we raise outside capital, for these 21 zip codes, there's not a lot of rentals in these districts already. Like they're really high purchase price, they're high property taxes. If I raise outside capital, I can buy and have basically a dominant market share position across all of those zip codes. It doesn't take a lot of money to be the largest provider of single family homes in elite school districts in the Midwest. And if I do onesie twosies, I can get a decent amount. But by being the largest provider, I set rents. I'm comping off myself when all my next properties hit the market, which makes it just that much easier for us to deliver the returns that we want and our investors want now.
It is really nice too, because real estate being such a supply and demand game, the fear is always, okay, I'm going to buy in a market and developers are going to realize it's a good market and they're going to flood the supply side of things. It's nice to know that they can't really flood the supply that much in the area they're at, because like enrollment at a public high school or private high school can only be so high. Like there's only so many
Mhm.
so many classrooms, so many teachers. Like I'm assuming that's a core part of the thesis, is that by being in these markets, it's actually intentionally supply constrained.
It's exactly that. So we're buying in areas where the supply is basically capped. For example, I was in one of our zip codes in Wisconsin earlier this morning. It was an early morning for me. If you drive around that town, every single buildable lot in town that could have a house already has a house on it. It is absolutely full. There is no possible way you can add more housing unless you knock down a bunch of houses and turn that into multifamily, which good luck doing in one of these zip codes. The residents in these areas are the final boss of NIMBY, and they
I
have
was
the
about to say that.
capital to, yeah, they've got the capital to bring lawyers into the equation and just prevent anything from happening. So your housing supply is basically as big as it can possibly be, which means the only way to rent is if there's somebody who buys homes and turns them into rentals.
That's funny. The final boss of NIMBY. Honestly, a good neighbor to have once you own it. So good on you. Um, uh, I read online that you had spent a year preparing for the launch of Scholastic. And from
Mhm.
my point of view, I'm thinking to myself, all right, I'm doing deals every single day. If there's a world where I find a really great deal that I can't afford to take down, I feel like it wouldn't take a year. I feel like I would maybe hit up a friend on Twitter, hit up a lawyer, try to find some wealthy people and syndicate something. But I know that you're not syndicating each deal. You actually raised a fund. Is that right?
That's correct. It's a true fund model.
So what went into that year that, if Sean of 2022, Sean of 2023 was listening to this right now, you could say, all right, here's the blueprint of what you have to do, and here are the things to avoid along that way.
It's a good question. The year part of it was structural. So I'll cover that exception in a second, and then we can go talk about the elements that went into it. The structural element to it is because we're buying in good school districts, most of the leasing activity happens during the summer. So we want to be buying and leasing during the summer. So when we started putting this together in like late 2022, early 23, it was either go super fast and be ready for summer 2023 or take our time for summer 24, which is what we ended up doing. That being said, there is a ton of stuff that needs to happen. What I think a lot of people tend to forget, and let's say the Twitter world, for example, is we're talking about what is basically an SEC registered non-traded and non-traded fund, and with a real estate fund, there are a ton of rules that need to be followed. This is not something that the standard attorney can put together. So having an attorney who specializes in this documentation, you're going to need a fund admin accounting firm. It takes a long time to find a good one, vet them, add in a tax prep accounting firm. Getting those vendors together alone should take a couple of months, and then putting the docs together should take another couple of months on top of that. So I guess the two main parts is number one, getting the right people on the bus, and number two, getting the bus going in the right direction. Alone should be about a 6 month activity, I think, if done correctly, or at least that was about the speed that we went about it.
Why raise a fund in the first place as opposed to syndicate each deal?
For us, is a function of the price point. So we're buying homes right now. Our average purchase price is 487.71 right now. At that price point, it's hard to syndicate individual deals. Also, these homes, not uncommon for a home to go under contract within 24 hours because they're really desirable homes in great areas. By the time we actually got the deck together, investor materials out, like it would probably already be under contract.
Do you like that? Like, do you like competing against the emotional buyer, right? Because effectively you're looking at everything here as I have my number. I know I can pay on a square footage basis or based on what the rental rates are in the area. And it's an equation for you. To somebody else, it's the tile floor in the bathroom is so nice. And well, there's a pool in the backyard, so we gotta have it. Like, it's that emotional decision, and they're willing to make fiscally irresponsible decisions because they
Mhm.
just need to have it. How do you feel how do you feel about competing against that type of person?
It's, I think, substantially easier. I really do. There's a lot of downside to single family homes, but the biggest pro to it is I'm competing against mom and pop buyers. And in most cases, it's a situation where, hey, um, we have the ability to make the best decision in place for our economics, and most people don't think about it that way when we're talking about mom and pop buyers. The other thing that really works for us in our favor is we have a lot of cards that we can play that a lot of mom and pop buyers don't. Mom and pop buyers is the old stereotype of like the father-in-law shows up to the inspection and points out everything else is wrong. Like for us, we are a much safer bet for the seller to go with because we aren't going to get emotional and have a father-in-law who walks us through the property. Like we have the inspection report done and it gets sent straight to the general contractor who goes through it in detail. Yes, no, thumbs up. Like we are a much safer bet on that regard. So I think it's better to be competing in the single family world against this kind of mom and pop buyer, but also in the single family world against the other landlords in the area. Like if there are other rentals available in the towns that we're in, it's going to be a local dentist or doctor who is doing this part time and is typically fairly unsophisticated in terms of how they're thinking about it.
I've seen posts from you in the past of something hits the market and you're there within 24 hours or you're on site immediately. The commercial real estate world that at least I've been playing in and talking to some other GPs that are playing in it as well right now, it really seems like the best deals are coming off market typically. And I know that's just not really as much of a thing in the space that you're playing in. Are you guys just quite literally sourcing and setting up the alerts on Zillow every single day where the second something hits the market, you know about it? Or are you talking to the realtors in the area saying, hey, the second that somebody texts you saying that they want to sell, send me the text and I'll give you a $2,000 bonus on the spot? I don't know if that's illegal or not, but what are you doing?
Yeah, so the vast majority right now, and this may change in the future because we're testing a couple things, but the vast majority of homes are on market homes. And we worked with a developer. It's really just a fancy Airtable. But what it's doing is it's piping in all of the homes on the market into the Airtable. It's basically through a series of funnels, funneling out like 99%, 99.9% of those homes. And then the very few homes that actually get spit through, we move on very, very quickly because we know it already fits just about everything that we need for this home to make sense for us. At that point, it's really a question of can we get myself or somebody else in that home as quickly as possible, just to make sure that it actually is what we think it is. And if so, we can get the offer in as quickly as possible. Like it's actually funny. I know for a fact on about 25% of our properties, and I strongly suspect on another 25% of the properties, that we were actually not the highest bidder on the house by a pretty considerable amount, but we still got it because we got the offer in fast. We got it accepted before anyone else. And we were also viewed as a sure bet to close, which we're a lot easier to finance than the standard mom and pop buyer.
Honestly, a really, really good competitive advantage, I would imagine, in today's market too, especially with like somebody going to the bank and suddenly realizing that the 2% rates or 3% rates that were a couple years ago are no longer. So that's really cool to hear. I'd love to actually get really tactical here at this point and we talked about kind of how you're finding some of these. Like, I would love for you to run me through a couple of these deals that you're doing and like get an understanding, and obviously all of this to say like, no promises or guarantees on any of the type of stuff that we're talking about here, but like hypothetical situations of what type of house you would buy, what the rents are, what you expect them to get to, and like really what this strategy is. Because I think if I remember correctly from talking a couple months ago, this is not a buy and hold forever strategy. That you have a pretty clear outlook as to what you're looking for. Is that correct?
We do have a pretty clear outlook. There's some wiggle room there depending on our LPs, but we can talk through in terms of exactly what that looks like. So, to your question, like houses, homes, what that looks like, tenants. So, right now, I mean, I've got all the numbers up on my screen right here. I'll give you all the live numbers. So we average purchase price right now is the 481,778 that I mentioned earlier. We are renting these homes right now for 3,932 a month right now. That also typically includes like a 1 month move-in fee rather than a security deposit, which is a little bit of an added boost because it's all NOI right there. In terms of our standard leases and what that looks like, our average lease length is 33 months at initiation. So almost everything's a 3-year lease. We do have a couple 2-year leases scattered in there. The So yeah, that's our standard lease process. All of those leases have annual escalators attached to them. Our average tenant income right now is $218,000, 178. That's verified with pay stubs and all that good stuff. So we're talking about a fairly well-to-do individual, and we're talking about a fairly well-to-do individual who wants long-term security in terms of, hey, this is a good house and I want to stay in it for long term. Those houses 481, we're averaging 3.1 beds, 2.1 baths, 1781 square feet, I think it was. Something 1780, 1753 square feet right now is our average house.
You get the numbers down.
Spend a lot of time staring at this on a day-to-day basis. So we buy them up, release them out, and then we do monthly distributions out to our investors. That's going to start up this September or October. And the goal is those distributions are, if we can, getting as close to paying off pref, which is 8%, so we possibly can. And then the investors own the underlying equity in those houses as well as the houses appreciate in value. As we pay down the 30-year mortgage, we get more equity there. I should tell you, mortgage, our existing debt, it's 30-year debt, weighted average of 6.02% across the portfolio right now. That's 30-year fixed. So yeah, investors get the monthly distributions, the equity appreciation, and then the plan when we put this together was to sell the portfolio in a package in 10 years down the line at a cap rate to a larger institution who's assembling SFR portfolios. What has happened is the vast majority of our LPs have said, I don't want to sell. So we're now at a point of like, we're going to hold these homes until somebody overpays for them. And if they don't, then we'll just keep on holding the homes forever.
You said a bunch of things that I want to dive into, and I want to make sure that I can approach it in a way where we're not
That was
jumping.
long. Sorry about that.
No. I love it. I just know I want to ask all of them and not forget any. So, okay, the first and foremost one, I think it's rare for a GP to pay monthly distributions. Am I wrong in saying that?
It is rare. To our knowledge, we're one of very few funds that do this.
And why do you guys do that?
The only reason we're doing it is because we can, and our LPs have seemed to want it. On the seem to want it perspective, like it's no different from a cash flow amount than what they would get on a quarterly basis, but just the idea of having it direct deposited monthly has thus far seemed interesting. The why, because we can, like why we can and other funds can't, is that 33-month average lease right now. Like I have very strong security in what my cash flow is going to look like 12 months out, while most funds say, hey, 40% of our leases are coming up in 6 months and the other 40% is coming up in 8 months. We don't know what renewal rates are going to be. We have to keep a bunch of money on hand in case the houses are trashed when tenants move out or whatever. Like I'm amortizing that cost over a lot more time. I've got a lot more security in my cash flow. I can push the money out knowing that I'm going to be pretty good on it coming back in.
As far, and this one just popped up in my head as we were talking. You buy a property, today's July 1st. Let's say you close on a deal today. How long does it typically take you to lease that property out based on what you've seen in your portfolio so far?
There's been a big range in this right now. We're leasing everything.10 or 11 days. But wow. It's fascinating because we've had some homes that have leased in sub 8 hours, and we've had some homes that have taken like 3-4 weeks, sometimes in the same town. So we're getting a lot of data on the leasing side that we didn't have before. And I think that's the next kind of like really big nut to crack for us, is figuring out like what's the commonality? Why are these homes renting in 8 hours, and why are these ones taking 3 weeks? Because if we can solve that, then I think we're going to be even better on those homes that are getting filtered through that we actually end up buying.
I feel like the 8 hour one, I would quickly turn it, like, even if it's you do all the market research and you're like, I know it's $3,500 a month. That's what I should be charging, $3,500 a month. And then someone's like, I'll do it tomorrow. I'm like, actually it's $3,700 a month. Like, I feel like I would have a second thought of, damn, maybe I maybe mispriced this, or I could have gotten more out of this, but that's just my brain thinking that way.
No, I think it's a fair, I think it's a fair comment, and it drives me nuts. Like, as an illustration, for example, we had it's one town, it's in Wisconsin. I rented one home, on technically actually before it even hit the market, for 3850. And then we own a comparable home that's about a tenth of a mile away. It's about the exact same home in almost every respect. And that one took like 3 weeks to rent for 3,300. It's like I don't know the difference yet, and like it's the big task for me to figure out. It's exactly what the differentiation drivers are between all of these different homes.
I wonder if you turn around to the tenant who's already on this 3 year lease now and show them the other one and say, hey, by the way, how much would you have gone and paid for this? And I wonder if maybe you just got lucky to some degree with having a tenant who's willing to pay for that amount, but very interesting to hear. Um, as far as, one other thing that you said, that so personally, I always like the buy and hold forever strategy. Obviously things change, right? I think it's always nice to go in with that strategy and then suddenly say, oh, something like a killer high school opened up 2 towns over, and now suddenly the demand is less, or something like that, right? Like, always be willing to be flexible. But something that you
Mhm.
said is the LPs wanted to hold forever. You're cool to play ball there. But years down the line, somebody comes in and they offer you a two cap on this massive portfolio that you've built out, right? And it's BlackRock, and they want to take over the world, and they're like, "Yep, BlackRock wants Sean's thing. Like, we want Scholastic. We're going to take it over." How did you structure your fund to decide who decides that?
So the decision making authority in terms of how that's like officially done is that's done at the GP level, of which I have the majority of the control there. I do have a partner, who's got a portion of the GP, and then we have it's 5 advisors now. They each own 1%, that all have, think of them basically as a board of directors who all weigh in. That's the like technical legal mechanics for it. The way that I've done it in practice is we've told all of our LPs, that if we do get an LOI on the table, we get a number on the table, we're going to have our accounting firm run the waterfall and say, hey, for Joe Schmo, means he's going to get $722,000 or whatever, and Sally Sue is going to get this much or whatever, and then we send them all of them, their individual numbers, and say, hey, like, if we take this offer, this is exactly what your direct deposit's going to be. Thumbs up or thumbs down. Is this the number you'd be happy about, or is this not good enough to give up? Because what I found is when I talked with them, I'd be like, hey, if we get an offer for $500 million, would you sell the portfolio? And they're like, maybe, I don't know. But if I go back to them, I'm like, hey, if your initial $250,000 is now worth 1.4 million, would you take that? They're like, yeah, I would take that. Like, then it makes it a lot more tangible.
That's very well said. I think that the actual showing of the profit is a much different game. Um,
Mhm.
I want to talk about essentially fee structure slash how a fund works, because I think something that I've learned on my side is we do too small of deals to make investor capital make sense. I would have to do a ton of these small deals, and to be honest with you, doing a ton of small self-storage deals would be horrible. Just the property management on it alone is a nightmare. Such high expense ratios, it doesn't make sense for us. Can you walk me through, if you want to, on the LP side? I think that's definitely interesting to know, like, what your pref is and how all that works. But, like, I'm even really curious from a GP side, like, how do you make money with all of this?
For sure. So how we make money, what fees look like, and what it works. So we have a fairly traditional like fund and syndicate structure of an 8% preferred return and then an 80/20 over the eight. So what that basically means in practice is the investors get 100% of the money of the 100% of the profit the fund generates until they've made 8% on their investment. So let's say someone gives us $100,000. They are going to get 100% of the profit the fund generates until they get 8 grand for their 8% return. For the 8,001st dollar from there, they get 80 cents of that dollar, and we get 20 cents of that dollar. So for us, and the reason why this is good is it aligns incentives with investors. Like we are incentivized to make sure that we're doing well better than an 8% return on their investment because we don't really get paid until we get into that 8,001st dollar. So that's really where we make the money, and like that's where the way it should be. There are other like fees associated with real estate funds and private equity funds in general. You've probably heard the like 2 and 20 fee structure. Like we have a fee, it's 1.5%, and so we're a little bit lower. That fee really pays for salaries of employees to monitor the investment.
Okay, so and I wanted to just jump in there just to be explicit. So
Mhm.
it's a 1.5 management fee, just to slap a title on it.
Correct. It's a
So
1.5% management fee.
I've always wondered this, and I tried Googling it prior, and I know it's going to be the dumbest question you get all day. Can you explain to me, like, very tactically how that works? Because here's my interpretation of it, just to use
Mhm.
easy numbers. You raise $100 million fund. Okay, $100 million is sitting in a bank account. You now take 1.5 million and move it into a separate bank account. You try to start deploying all of that capital, and then year two turns around. There is, again, just using easy numbers now. Now there's $98.5 million sitting in a bank account. Assume like I would imagine you deployed a bunch. Now you take 1.4 million or whatever the math is on that, and you put it into a separate bank account. Is that how that works, or like am I being very simplistic and wrong about that?
No, it's a really good question to be asking because there is no standard doctrine there in terms of how this works. There's a lot of different ways it can be done. And it depends on your fund structure and it depends on your objectives and how things work. We are slightly unique in this because we're what's called an evergreen fund, meaning most funds are like they're called closed end, meaning it's a 10-year fund, and on the 10th year, first day, the fund explodes and no longer exists. We're an evergreen fund, which means we could theoretically go forever. So for us, 1.5% management fee is based off of NAV, which is basically the equity value within the fund. And the reason why it's set up for that is like, let's say 100 years in the future, Scholastic still exists. If the management fee is 1.5% of what was initially raised, like it's probably not covering expenses at that point. So for us, the way that works is every quarter. Today is actually the first day. We recalculate NAV, which is basically what is the equity value of all the homes less the existing debt plus the amount of money in the bank, and then it's a 1.5% annualized fee, so 0.375% of that value per quarter gets transferred from fund bank account to fund expense bank account that we then pay salaries and all that out of.
Yeah, I appreciate you explaining that because I've always like I even have the stupid questions when I ask people who have sold big companies, and it's the $50 million exits, and I'm like, all right, everyone always talks about that, but like tactically, is it one wire transfer or it's always sometimes I really nerd out on the really nitty gritty details on that part, but that makes sense. I think the only thing to further clarify there is when you are calculating that equity, are you having a third party appraisal company come in quarterly and tell you how much your house is worth?
Yes, we are. It's a conflict of interest if we as the fund are the ones who are like putting the value on the fund value fund assets. So the way that it works is at least for us, we're lucky. With single family, there's a company called House Canary, which is industry standard. They are an evaluation service online, and they're the only, to my knowledge, they're the only online one that's lending grade, meaning lenders can use it in lieu of appraisal. So it costs us $4 per property per valuation. So we just pay $4 per quarter, and then they spit us out valuations. We use those to value the properties. If you don't have single families, or you're doing a different asset class, like it gets a lot harder to do, and you end up having to pay a big bill to a professional to go out and actually do the valuation.
Sorry, what is that called? It's something canary?
House Canary.
Cool concept. Honestly, cool, very cool business model in general. Um,
Mhm.
and talk to me a little bit about what this decision was on choosing an evergreen fund versus an open and closed fund where you could, I guess, essentially raise a finite amount, show a fixed return, turn around and try to raise a bigger fund in the future. I feel like that's pretty common of a lot of GPs.
It is common for a lot of GPs. It's actually the exact business model from a GP perspective of I'm going to raise a smaller fund, I'm going to do really well, and I'm going to then run to raise a bigger fund and then a bigger fund and then bigger fund and then bigger fund, and then you're managing $1 billion, and your 2% off $1 billion is keeping you like well clothed and fed in the Hamptons. That's not the model that really works for me and my partners. Like we're not looking to continue to raise bigger and bigger and bigger funds. Like we're not looking to um have 10 different funds down the line. Like we want to do Scholastic right with feeling. We don't want to do like a 2 or 3 year world and then kind of roll it up. So for us, Scholastic is the only fund. We're actually a rolling fund structure. So every dollar we raise is within the same vehicle itself. And an investor who invests today versus 5 years from now will be investing in the exact same vehicle. The guy 5 years from now will be paying it at a higher price because NAV theoretically has gone up over all the years. But he buys in or she buys in, he or she will own a piece out of every single home we've ever purchased.
That's really cool. I also think that the thing that just kind of clicked in the back of my head here too is assuming that you do the buy and hold forever esque model, and the big if, assuming that rental prices continue to go up nationwide, or at least in the districts that you are buying properties in right now, that the ability to hit that 8% actually becomes way easier, right? Am I right in saying that? Because I put $100,000 in 2010, and it was getting me a 10% return. Let's just use an easy number. And that was a 10% return based on the rental rates that you were getting in 2010. Now it's 2024, and the rental rates have doubled, let's call it. And theoretically, on that 100,000, I'm now getting a 20% return on that original amount that I was putting in. So it's an easier thing for you to kind of take off the top too. Is that right?
That's right. And it fits in well with what our investors are looking for. Like um we have a lot of, I call it sophisticated LPs who are LPs in our stuff and they're LPs in like development deals or reposition deals. And we are like the AT&T stock in their portfolio. We're like the monthly safe dividend while they have the like GameStop, Nvidia high yield bets over here. But we also have a lot of individuals who are like doctor lawyer type individuals who, like, if they had the time and or knowledge, they would buy 1 or 2 houses a year and just pay them off over like a 10-15 year career like we've talked about. But they don't have the time or knowledge to do so, so like they're investing with us. So like the idea of them getting more and more cash flow over a 10-15 year period like fits in really well with what they're looking for, because ideally that's what they would be doing if they had the time or knowledge.
Absolutely. You guys make it easy. As far as those LPs, I would imagine a lot of it's Twitter, but talk to me. I guess before we talk about every channel that you find LPs from, I'd love to talk about what happened with your Curbed article a couple months ago, and how that might have attracted some very much a wanted interest, and then maybe some not so much wanted interest, if you want to go into that.
Yeah, it was interesting. So we Curbed magazine, which is New York Magazine's real estate section, I think, reached out about doing an article on us. And um I was very skeptical because like the evil Wall Street firms buying up houses is kind of a big talking point right now. Um, but the art, so we ended up doing the article and ended up being very flattering. And it talked about how like we actually might be the rare circumstance where it's better for the individuals if it's a fund that buys houses versus not. But to your point, like we got a lot of investors who saw that article and they're like, "This is really smart. I'd love to do this." And we also got a lot of the exact opposite, I guess we'll say. And then that article actually had a second life about a month or two later when TikTok found it, and then it was kind of going all over TikTok, which I don't have TikTok. but I had a couple people reach out to me being like, "Hey, I saw you on TikTok." Although funny enough, we did get investors from TikTok as well, which is not a phrase I would have ever expected to have said in my life.
As someone who was once the most hated man for one day on Reddit, I also had a post that went too viral. Unfortunately for me, it wasn't in the Wall Street Journal or in any spot that reputable people see. It was on r slash I think anti-work on Reddit. So it was
Oh no,
only
yeah,
it was quite literally only the people that I wouldn't have wanted to see it. I can very much so empathize with that. So at least you got some investors from it. Hopefully the hate died out after 24 hours, as they seem to do with viral internet content. But I definitely can understand that. Um,
yep.
how else has it been for you in terms of getting LPs? Has it been easier than you expected, harder than you expected?
It's a good question. I guess I didn't really know what to expect going into it. And I think in some respects it was easier, and in some respects it was harder. What made it easier is uh, we have what I think is a very approachable thesis. Like I explain it to people and they're like, "Oh yeah, like and buying homes near good schools, like that makes sense." If I talk with somebody who's got school age kids, it's even easier of a sale or conversation because they're like, "Hey, like I have moved to a better school district for my kids. I am your exact target demographic. I completely get it. Where do I invest?" Which is a really fortunate thing that was not by design, but we kind of resonate with a lot of LPs that way. It makes it, I think, puts us in a fortunate position with investors. The flip side to this is it's an asset class that people tend to not love a ton in SFR for various reasons, pros and cons as to why. And we're also what's called an emerging manager, meaning it's our first time running a real estate fund, which is a very reasonable hesitation in a lot of people's minds. Like, hey, do we really want to wire millions of dollars to this guy in his late 20s who has never managed outside money before? It's super reasonable. Um, so it was been an interesting journey to say the least. But what I do firmly believe, and everyone I've ever talked to says something very similar. It's if things go well in your first fund, it is going to be the hardest money you've ever raised because the second one you now have a really strong data point to point at, and so on and so forth as it goes on from there.
I was just trying to think about what they would be. What would the data points be for you in the concept of an evergreen fund, right? Because you can never say we fully, the number is changing every single time that you get on the phone with an LP. So knowing that, I would imagine over time, right? Like LPs have rich golf buddies or boating buddies or whatever. People talk in the surgery office or whatever as their doctors, and they're like, oh yeah, well I get a check every single month from Sean over at Scholastic.
Mhm.
How do you quantify that? Is it like, hey, for somebody who invested in 2023, here has been their return. For someone who's invested in 2024, here's their cohort return. Like, how do you think about that for future LPs?
I think there's a lot of different elements to it. Part of that is exactly what you said. Like, hey, let's somebody put $100,000 in on day one. Like, this is what's happened to them in all that time since. Number two is someone later on is buying into all of the existing assets. So I can put the pictures on the screen and be like, hey, you're going to own 3% of these 70 homes. They're rented for this. The average purchase price was this. And like, we have a lot of data on it. Like my fridge is my oldest piece of equipment in all my houses. And my fridge average across all my homes is 2013. So I can be like, you're going to own a lot of 2013 fridges. But like things like that, where like it just makes it more concrete for the investors. They know exactly what they're investing in. And then so the other thing that you mentioned that I think is really critical is communication. When we first started putting this together about a year or so, we talked to a lot of LPs. We're like, what is your biggest pet peeve in all of your investments? Like, what is a good investment versus a bad investment? And the number one thing that we consistently heard was communication, and their bad investments have terrible communication. So we are very focused on being the best possible communicators to our LPs. Every LP email is responded to in 24 hours. We send out very detailed reporting with a lot of numbers. And I very want to make sure that we can put our reporting up against anyone in the world and make sure ours is as good or better. And that has gone a really long way with investors feeling confident of, hey, I know where I'm at. I know where the investment's going. I know what's top of mind for the guys at Scholastic. And as a result of that, like I feel good about things rather than me having to worry and wonder like what's happening over there.
Kind of perfectly transitions to my next talking point here, which is you seem to be very on the ground in Wisconsin in the morning, or something hits Zillow and you're in the car driving over. How do you look at your role as it stands in the first 1 to 2 to 3 years of growing Scholastic? Because I find that most GPs typically lean towards I'm a hirer and I'm an investor relations, guy, plus, being able to send out the monthly updates and communicate. It seems like you are both leading acquisitions, leading investor communications, doing the marketing on that side as well. Like what's your role on a day-to-day right now?
It's a good question. I mean, so we have our fund fees hit today, so we have money to pay salaries today. So we have a bunch of people starting, but at its core, like where we're heading and where we're hopefully going to be in probably 3 to 4 months is my focus is going to be on a couple different things. Like one, fundraising. I'm assuming it always will be. Like if I was going to write a $500,000 check to somebody, like I would want to speak to the guy who's running the show. And like I feel like I owe investors that for sure. Like if somebody wants to write a check, like I'm willing. I of course will be willing to speak with them. But the other thing to your point though is acquisitions. Like this I'm a big believer in that, like you need to buy the right real estate. And I think that is, if there's anything in the world that I'm good at, I think it's that. Going back to what we talked about earlier, like I moved 22 times growing up. I got my real estate license at 16, 17, 18, took the course as soon as I was eligible to in New Jersey, which is where I lived at the time. Um, I this is what I think I know really well. And I think I can prove it because our valuations on the homes, we're buying them at rates under what the market is actually valuing them at. So that's not something I want to hand off for at all, because that's something there I think where a lot of value is actually being created.
And I think it makes you more credible too when you're talking to the investors. It's when you just begin to adding a lot of layers of separation between yourself, who's buying it, who's operating it, the day to day. Like you clearly know your numbers just from being on today's call, right? And so being able to jump on an LP call when you do need to raise that $500,000 check, or in the future even bigger checks, it goes a long way to the credibility piece, which I think is really nice. The last two
Thanks.
things that I want to kind of wrap up here with today are pretty simple. You talked up to plenty of LPs, over the course of your career, and have definitely raised a good amount of money there. It also sounds like you've given up a little bit of equity to find the right mentors in the space and advisors to make sure that you're shepherding that money in the right direction. What would be, call it the top tip or piece of advice that you have received from some of those advisors along your way that's really shaped how you've thought about building Scholastic? And then what would be one thing that you today would tell somebody who is thinking about writing a check into a private real estate investment?
Great question. So the top piece of advice that I think I've received is um, build it slow and build it right. Like I think a lot of people have oh my gosh, I found a good deal. Let me get a syndicate together. Let me start moving. Boom, 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 boom. And they're like 4 weeks down the line, they're starting to call investors. I think it is much better to take your time, do it right, get the right people on the bus, going in the right direction, have a plan, have a backup plan for everything. Um, I am a big believer of like if you do it right, real estate is a 10, 20, 30, 40 year ball game. If you try to win the whole ball game in the top of the first inning, like you're playing a fool's errand in that case. And like, hey, maybe it might work, but it's could very well not work as well. Um, and then my top tip for somebody who's thinking about investing in a real estate fund or syndication is making sure that somebody knows exactly what they're looking for from an investment perspective. And what I mean by that is there's a lot of different options out there. And the best LPs that I've met and have work with us, who I work with, the ones who've been doing this for a long time and have consistently made money, are the ones who very much know what they want from an investment. Are they a I just want monthly cash flow person? Are they a I want no cash flow and a big check in 6 years? Are they I don't care about either of those first two, but I want to say that I own a piece of a really cool piece of real estate? Because there's a lot of investors who fit the bill there. Like, understanding who you are matters, and then from there it helps you filter into the kind of investments that make sense for you. Like, we are great for some investors, but we aren't a good fit for others. And I think it's important to understand there's a broad spectrum of investment funds, and like, find the right one that's tailored for what you want specifically.
That's great advice. Sean, I think today's episode is awesome. If people want to check out Scholastic Capital, if people want to find the latest deals that you're working on, where can they find you?
We are scholasticcapital.com. I'm on Twitter, SeanO'Dowd15. I tweet a lot about what we're doing. And we also have a public facing newsletter from there that it lags our investor one by a good 30 days, as you'd imagine, but it is close to what the investors get in terms of from a numbers perspective and what's happening in the portfolio and what we're thinking about.
We will link to all of that below. Sean, thank you so much for coming on today's show.
Thanks for having me.